for our Interagency Guidance on Third-Party Relationships Risk Management, What It Means to Your Third-Party Risk Management Program webinar. My name is Jessie Redmond, and I will be your host. On your screen, you should see multiple widgets that you can use, including Ask Question, Media Player, Slides, Related Content, Speaker Bio, Request Demo, and Help. If you're unfamiliar with our webinars, all the widget boxes are resizable and movable, so feel free to move them around to maximize your screen space. At the bottom of your screen in the toolbar are icon buttons you can use to show and hide the widgets. You can expand your slide area or maximize it to full screen by clicking on the arrows in the top right corner of the widget. If you experience any issues or have technical questions, you can use the Help widget or submit them along with any other questions through the Ask Question widget. Don't worry, we do capture all questions throughout the session. We will be answering some during the webcast, but those that we do not have a chance to answer live, we will address with you via email. Today's live session is eligible for 1 CPE credit. If you wish to receive this credit, please remember to answer all of the polling questions that will appear on your screen during today's presentation. You will also be sent a follow-up survey link 24 hours after the live session that will need to be completed in order to receive the CPE credit. With us today, we have Hillary Dewhurst, VinMinder's Head of Third-Party Risk Education and Advocacy. She will walk through the new guidance and what it means for your organization's third-party risk management program. You'll see a link to a copy of today's slide deck, a link to our website, a link to our samples library, links to our 7 takeaways from the final Interagency Third-Party Risk Management Guidance ebook, the Third-Party Risk Management Lifecycle Toolkit, 7 steps of risk-based vendor due diligence infographic and matrix, as well as a link to our Interagency Guidance on Third-Party Relationships Risk Management, Summarized Due Diligence Requirements and Considerations document. There is also a link to our library of additional resources, all within the Related Content widget. And with all that being said, I'd like to hand it over to Hillary. Hillary, the floor is yours.
Hello, and welcome to this special edition webinar on the new Interagency Guidance that was just published in June. We're going to cover a lot of ground today, and we're going to start with an overview and some highlights of the actual guidance, and then we'll get into really what may be more important and what you need to think about as you get ready to ensure your organization can comply with this new governance. We'll also talk about some potential considerations and challenges you may come up against and suggest some practical advice about how to manage those. We'll wrap up with some key takeaways also, so let's jump right into it. Well, as they say, the other shoe finally dropped. I mean, after all, we've been waiting almost 2 years for this proposed guidance to be finalized. You know, just as a reminder, the guidance is Interagency Guidance, which means the OCC, the FDIC, and the Fed decided it was time to get together and align their requirements and just come up with one set of guidance for banks and financial institutions of any size. Now, in theory, this harmonization is meant to drive consistency and promote better practices across the industry. It's important to understand that the guidance is in effect now and replaces anything that was previously issued on the topic of third-party risk by each agency. Now, if you've been following this, you'll know the initial proposal for the guidance happened in July 2021, and they had a very long comment period, and there were a lot of comments from the industry, but not just from the industry, but from the general public, as well as vendors who serve the industry. Now, if you need some light reading, you can review the approximately 25 pages where they talk about all the comments and the rationale for either not making a change or what they did in response to the comment. The bottom line is the proposed guidance that came out almost 2 years ago is almost verbatim the final guidance that we got in June. So if you're one of the many folks that's on the webinar today that is not with the bank and you're wondering, does this interagency guidance really matter all that much to me? Well, first of all, if your organization serves the financial industry, those are your customers, then yes, you should strive to understand and incorporate this guidance. But even if that's not your situation, it's important to understand that financial regulators have more or less been the pace car for best practices in third-party risk management. Going back to the OCC guidance in 2013, that was widely adopted and accepted as the gold standard. And so now a lot of the things that were in that guidance are considered best practices today. Following a risk-based approach is what this guidance is all about. So virtually almost every industry can extract really valuable and practical information from this guidance so that we can all have effective third-party risk management programs. So there are two big questions about the guidance. The first one is, does it matter how big the bank is? You know, are there different requirements, say, for that mega national bank versus the community bank? And the basic answer is no. That's not to say that the agencies have not recognized that there might be certain challenges for smaller and community banks, and they have pledged to provide additional resources or support documents in the near future to help these smaller organizations understand and achieve compliance. So basically, it applies to every bank regardless of size. So the next big question is who or what is in scope for this new guidance? And this is probably the area that's going to give people the most anxiety because this new guidance is applicable to every business arrangement or relationship you have, with the exception of your customers. So we're not just talking about typical vendors who provide products and services anymore, you know, the ones that would have always been very obvious for your third party. But now that this definition, or the scope rather, has expanded, it's also independent consultants, referrals, and joint ventures, things like fintechs, data providers, credit agencies, and services provided by your own affiliates and subsidiaries. And just to reiterate, every business arrangement, every business relationship you have, excluding your customers, is in scope. Now, for those of you who worked under the previous OCC rules, this is going to cause some anxiety even for you. But don't worry, we're going to talk about some strategies and really walk through what this means later in the presentation. But it is important to realize and really understand that we are talking about third-party risk management in the most fulsome terms possible. This is no longer just about vendors or suppliers or service providers. All right? So now while you absorb that information, I believe it is time for our first poll question. Jessie?
And this brings us to the first poll question of the day. You should see the poll question now in the sides area. If you have any issues, please feel free to send us a message using the Ask Question widget, and we will be happy to assist. As a reminder, if you wish to receive the CPE credit for today's session, you must answer all poll questions and be in attendance for the entire live session. This poll question is, have you read the Interagency Guidance on Third-Party Relationships Risk Management? Yes, yes, but I don't understand all of it, some of it, or no. Hillary, we have some time now to answer one of the questions that has come in from the audience.
Okay.
And this question is, I know the guidance became effective on June 6th, but is there any kind of grace period for compliance, especially since they expanded the scope?
Well, the official answer, or not the official answer, but the answer is no. The guidance clearly states that it's effective as of that date, which means that is the standard they're holding you to. You know, sometimes when they are doing new regulatory guidance, they may say, you know, compliance date must be by, you know, X time or with 120 days. But there's been a lot of attention, a lot of feedback, or rather communication from the regulators that they are going to be focusing on compliance to this new guidance. So because they've expanded the scope, that might mean that some of you have some extra work to do, and you may be feeling stressed out about being in compliance. What I might recommend is documenting the areas that you have gaps in, and also documenting your plan to close those gaps That way, if you do have an internal audit or you do have an exam before you're completely compliant, at least they will be aware of the work that you're doing, that you have awareness of it, and that it's an issue you're actively trying to close. I hope that helps.
Thanks, everyone, for answering that poll question. Here are those results. By the way, you may have noticed reactions such as a thumbs up or heart coming across the screen. If you find this feature distracting, you can turn it off by clicking the 4 arrows in the top right-hand corner of the Slides widget, which will expand the slides to full screen and no longer show the reactions. Before we move on in the related content widget, I'd like to make you aware that you'll find our 7 takeaways from the final Interagency Third-Party Risk Management Guidance ebook. This ebook compiles some essential details to be aware of from the guidance. With that, Hillary, back to you.
All right, so now we're going to dive into some highlights and basic requirements of the guidance. And one of the first ones, it's not a new requirement, but it's still super important to follow the third-party risk management lifecycle for all of those business relationships. And keep in mind, not just in the guidance, but throughout this presentation, that all the examples and considerations that we're talking about, they're just not going to be relevant to every single relationship that you have, because there is not a one-size-fits-all approach. We need to just understand and show that the organization has good judgment and consideration on how they're going to apply some of these requirements when it comes to third-party risk management. So there is a little bit of flexibility. But one thing that is really important and shouldn't be too flexible is that you have to have good, skilled, and knowledgeable people engaged throughout that third-party relationship. So that could be your InfoSec team, or your legal department, or your compliance officer. What we want to make sure is that those folks that are involved in third-party risk management, whatever capacity, are skilled and competent people. So I want to get back to the life cycle for a moment. So in the corner here, you'll see the information, or the graphic rather, that the regulators show of the life cycle. And it looks like this continuous circle surrounded by this triangle. And I want to point out that we have flattened out this life cycle for multiple reasons. One, just because it's much easier to see where you are at any given point in the relationship. You can clearly see the 3 stages, which are onboarding, ongoing, and offboarding. And it looks like a little bit in the regulator's version that every single thing repeats. It doesn't necessarily. But a really important notion here, and something that I want to point out, is that all of these processes are all supported by a foundation of governance, which is really all about oversight and accountability, documentation and reporting, and independent review. Now, it doesn't really matter what kind of graphic we're looking at here. What is important is that we understand the steps and activities that are required in each relationship and that foundation of governance. All right, I am going to keep going with the highlights, and I'm going to start with the very first step in the life cycle, which is that planning for the third-party relationship. This can be an area where organizations can be a little bit weak sometimes, and I want to make sure that everyone understands that planning for that relationship means understanding why we're engaging this third party, if the activity that we're asking them to do is really strategic for the organization or it aligns with our goals. We need to know that we have the right resources in place to manage it. And if we're going to be dependent on external resources to help us assess the third party, we also need to know, and this is a big one, how that relationship may affect our own employees, especially if that activity is being outsourced. And we should think about which policy, whether that's third-party risk management or other policy, is going to govern that relationship and its requirements. Now, some key things we need to think about from the guidance. Again, these are not new requirements, but these are considerations that you should really think about. The first one is that not all relationships require the same level of risk management, right? They really don't. There's not a one-size-fits-all approach, and the guidance is fairly flexible in allowing your organization to make some decisions and determinations about what is required to effectively manage the risk of each business relationship. Now, when it comes to each business relationship, what we do know is we know we need to have a very good inventory of all of those relationships. It should be telling us the type of relationship and the risk associated. And that means that we are doing risk assessments. So we're doing them initially, and then we're periodically going back to reassess that risk and determine whether those risks have changed over time. We also need to identify critical third-party relationships. Again, not a new requirement, but the guidance is really emphasizing and reiterating what are those characteristics of critical activities, i.e. our critical vendors, the ones performing them, include those that could cause your organization to have significant risk if that third party fails to meet expectations. They can impact your customers or have a significant impact on the banking organization's financial condition or operation. It's up to each banking organization to identify its critical activities and the third parties that support them. But not, again, just for banks. This is a best practice no matter what industry you're in. So, not a new requirement, but due diligence is still a very important activity. It's true that we need to know who we are doing business with. We need to understand if those entities, those that we're just having the relationship with, have the right risk controls and practices to manage the risks that have been identified. We have included today as an associated download a summarized version of all of the due diligence requirements in the guidance. It's a lot easier to read. It maybe simplifies things a little bit, but I do want you to download that and hang on to it. And I'm going to tell you a little bit more about how you can use that summarized version as we get further along in the presentation. One thing that's really interesting and kind of great about the new guidance is that the regulators have admitted basically that sometimes due diligence is hard. It is hard to get that information, and that you may not be able to get everything you need, so they want you to think about other alternatives, like maybe trying different types of information to substantiate controls, or maybe implementing additional controls internally or adding extra monitoring, or just simply using a different third party. Whatever those limitations are, make sure you document them and what alternate information you're using to make your decisions. Now, again, we can use some alternate resources. So that might be going to a risk alert and monitoring service and pulling a report about a vendor or business relationship cybersecurity profile. It can be collaborating with another organization. Just keep in mind that when you use these alternate resources in this supplemental due diligence, you're still responsible for the outcome. Your organization is still responsible for the outcome, no matter where you get that information, whether it's directly from the vendor or from a professional service. You need to manage those third-party relationships in a safe and sound manner. Again, not a new requirement, but ongoing monitoring is really important and it's expected. And typically that involves, looking at reports about the performance and controls, so that risk assessment and that risk reassessment. It means meeting with your third parties to discuss their performance in operations, okay? This is really important. It's just not looking at a report and talking about their performance internally. You've got to involve the third party. And then also testing the bank's controls for managing the risks of the third parties, right? Especially those that are high or critical. So monitoring can be done periodically or continuously depending on the risks involved and the types of product or service or business relationship that it is. Okay, so one of the things that the guidance really emphasizes is the responsibility of the board and management. So basically, the board and senior management, the buck stops with them on third-party risk management. So the board of directors, they're really all about oversight and holding management accountable. They should make sure that they are giving clear guidance on an acceptable risk appetite, approving policies, and making sure that everything is working as it should. That means that they're thinking about how well these risks are managed according to their strategy and risk appetite. And whether or not they're getting periodic updates on those third-party relationships, including that planning we talked about earlier, due diligence, contract negotiations, and monitoring. And they also should be thinking about whether management has taken the necessary action to resolve any deterioration in performance, including monitoring and independent reviews or dealing with changing risks, right? So the board is holding management accountable. Now, when it comes to management, we say senior management here, the guidance is management. I think we all know it kind of starts at the top and rolls down. They're basically responsible for ensuring that the third-party risk management program and practices are effective and efficient and that they're appropriate for the size and scope of the risk. They're also responsible for making sure that there are organizational structures and staffing, both level and expertise, to support third-party risk management. They need to notify the board when there's significant issues, and they are responsible for terminating business arrangements when they don't meet expectations or don't align with the bank's goals. Now, number 6 of the 7 key takeaways is all about independent reviews. We need internal audit, or even if we have to hire them, external auditors to come in and ensure that we have alignment between our third-party relationships and the bank's goals and objectives. We need to know that the risks are being well identified, measured, monitored, and controlled. They want to tell us how well these processes and controls are working and making sure that we have the proper staffing. This is so important, and I'm so glad that it's spelled out in the guidance. And also making sure there's no conflicts of interest when choosing or managing third parties. So our final takeaway from the interagency guidance is all about maintaining documentation and reporting, and the guidance does expand on these expectations a little bit, not new expectations, but just clarifying what it is that you need. I'm not going to read this whole list, but I will say that you need to be a good record keeper. We need to make sure that we have tangible evidence of things like risk assessments and planning and due diligence are being done. We need to maintain vendor control documentation. We have to document and report, any event that has a material risk, such as a cyber attack or a breach. We need to keep those audit results handy, and we also need to make sure that we are reporting to the board. So when it comes time for that exam, what are the regulators going to look at? What are they trying to supervise? When they come into your bank, they're going to want to know how well your management is handling third-party risk, okay? How capable they are of managing that. They also want to understand how that third-party risk is impacting your total risk profile, so your finances, your operations, and your legal and regulatory compliance. And they also want evidence of testing or reviewing the results of testing to ensure that all those activities that those business relationships are performing or delivering that they have been assessed for compliance with laws and regulations also. And while those supervisory focus points seem fairly vague, and that may be intentional, I will tell you what examiners look for every time they come in. One, they want documented policies that clearly spell out the requirements. They want to see that your processes are consistent with the requirements in the policy. And they want to make sure that your processes are executed consistently, right? Not that we do it sometimes, but that we do it all the time. They want to know about your stakeholder awareness and compliance, and they want hard evidence that your processes are being followed. So that's, documented risk assessments, due diligence, and monitoring, for example.
Our second poll question of the day is, our organization has mapped existing processes against the new interagency guidance to look for gaps or opportunities for improvement. Yes, it's in progress. You're planning it for the future. No, or unsure. Hillary, I have another question here that we can answer.
Great.
And this question is, what do they mean by using external third parties for supplemental due diligence?
This is actually a great question. So as part of the regulators sort of acknowledging that sometimes there might be challenges in getting information and due diligence documents, that they're saying that there are alternative ways that you can do that. That might be anything from using a risk assessment service, a risk alert monitoring service to say, hey, give us of this profile of this vendor's cybersecurity practices. It could be sharing information with another organization who maybe has some of that information, obtaining it from them. It could be, going out to the internet and doing all the research you can. What's really important to keep in mind, though, about any kind of supplemental due diligence is no matter where you get that information from, your organization is still responsible for the outcome. So let's say you get it from risk alert monitoring service. One, you should be really aware of that, the credibility of that service. You should review those results and treat them in the same way that you would as if a vendor gave you the document themselves. So just because you outsource that kind of help with due diligence, your organization is still completely responsible for the results. So I hope that helps clear that up a little bit.
Thanks again, everyone, for taking the time to answer that poll question. Here are those results. I would like to quickly direct your attention back to the related content widget, where you will find our third-party risk management lifecycle toolkit. If you're hoping to better understand the lifecycle, this toolkit contains an ebook, infographic, one-pager, and template, making it a very handy resource. Okay, Hillary, let's continue with the presentation.
All right, I know we've just barely skimmed the surface and given you some regulatory highlights and talked about supervisory focus, but I want to get to the heart of the matter today, and that is that now every business relationship has been scoped. And this is where, no doubt, your organization is going to feel the impact of this new guidance, okay? So the first thing that we want to consider is that we have to redefine third party and make it more about business relationships than vendors or suppliers. We need to do that in the policy. We also want to make sure that this guidance is a risk committee agenda item so that we have the right visibility, we have the right support, even helping us do things like internal communications about what the new requirements will be. We also have to think about how we're going to comply to this expanded scope. So what change management is necessary, how to help our stakeholders understand these changes, understand the requirements, how are we going to train or educate them to perform the processes to meet the requirements, and what are the impacts or the consequences of noncompliance. We also want to think about changes to our tools. Do we need to update that inherent risk assessment? Does the third-party questionnaire need to be changed, or do we need multiple ones based on the type of business relationship? We also want to think about due diligence for risk types that maybe we didn't think about in our traditional third-party risk management process. We also want to think about if there are certain types of third parties that might be governed by other policies, not the third-party risk management policy, so like an HR policy or a sponsorship and donations policy. We also want to make sure that we can update that inventory. This is really important. So we want to make sure we have improved our classification of products and services types, what that relationship is delivering. Okay, why do we have them? We also want to know who owns the relationship, that governing policy, and of course, the risk of the relationship and if they're critical or non-critical. All right, so the guidance is pretty straightforward, but it does not tell you how to get your whole organization to comply. Let's be real, this is a big project. Third-party risk management cannot do it alone. I mean, here are some of the things to think about. First of all, how are we going to get visibility into all those business relationships that have previously sat outside that third-party risk management purview, right? And then we want to know, like, has the risk of these relationships, have they been assessed? And if so, how did they assess it? And is there any evidence that they did? And then what level of oversight exists for these relationships today? Are they doing risk monitoring, performance monitoring? These are all questions we need to ask. And we mentioned in the earlier slide, if there are other policies that might govern some of these relationships, right? We need to identify what those are, and if they have crossover with our third-party risk management policy, do they need to be updated to include things like risk assessment? These are big considerations. Finally, what are all the entry points for these new business relationships? I mean, there could be your third-party risk management system, sourcing or procurement tools, your accounts payable, contracts, human resources, probably more. So we want to pinpoint all the ways that a new relationship can come into the bank. Now we're going to talk about challenges and roadblocks just a little bit later, but it's important to understand the different relationships have different risks. So managing them all the same way doesn't make sense, right? The process of conducting due diligence, for example, for your office supply provider may not be the same way or the same type of due diligence you would do for a revenue sharing agreement. So when we're getting in line and we're trying to make everything work and getting a little wrapped around the pole, go back to what is fundamentally important, right? These are the things that we need to make sure happen so that we can comply, that we have that inventory that's current and comprehensive, and that all third-party relationships are risk assessed in some fashion and determined to be critical or non-critical, and that they undergo appropriate risk-based due diligence. We also want to make sure that there is an OFAC check or similar review on these relationships, and that there's appropriate oversight. So somebody is monitoring the risk of that relationship, and they're monitoring the performance of that relationship. And then, most importantly, that there's documented or other tangible evidence of those requirements. We also need to make sure that third-party risk management issues are managed, documented and managed, and that the most significant ones for high risk and critical go up to the board. Okay, so even though it's up to every organization to figure out how exactly they're going to make this all work and comply, I am going to make some recommendations. The first one is to leverage your existing processes and tools wherever you can. So for example, once you've figured out all of those business relationships that have not been risk assessed, request that they, through their relationship owner, that they take an inherent risk assessment, that they use your existing risk assessment, and then use that inherent risk assessment as the standard for all new third-party relationships. All right, so if you're feeling a little bit anxious about asking, these kind of new business relationships that come in and take an inherent risk assessment, it's really important to understand all the benefits and leveraging these tools can have for your organization. So first of all, consistent risk ratings, right? We want to be using the same measure of risk on all our relationships. Otherwise, it's not meaningful. We also want consistent criteria for critical or non-critical relationships, and we want to be able to identify specifically the types and amounts of risk in that business relationship, because that helps us figure out due diligence. Now, earlier I said we had a related download that's a summarized version of the due diligence expectations of the guidance. The reason I wanted you to pay attention to that and download that is because when you're explaining due diligence to someone who's never had to put their business relationship through it, it can be really helpful to have that summary, to show them what it is that they are responsible for doing if they're not going to go through your process and they have to evaluate these things. I guarantee you they are not going to read the guidance, so that is why we've provided that list for you today. Also, just like everything else, we use these standardized kind of processes and tools that can help us figure out the right intervals for that risk monitoring, performance monitoring, and tracking. And if your processes are automated, which I hope they are at this point, it makes it so scalable for your organization, and it makes it so much easier to create that master inventory, that report, right? Because it's all in one place. All right, just to touch base on the inventory for a moment, because this is such an important component of the regulatory expectations. There's some things to think about here. The first of all is that different third-party types may potentially be managed by another policy. We mentioned it before, like an HR or sponsorship and donation policy, but whether or not they should be listed on the inventory. So let's just walk through this a little bit. All your typical vendors, suppliers, service providers, yep, they're already governed by your policy, and of course they should be on the inventory. But maybe some of these business relationships have been outside of third-party risk management, like marketing agreements, revenue sharing, fintech relationships. They should technically be governed by your existing third-party risk management policy unless there's specifically a policy that addresses it, and yes, they need to be on the inventory. Now we get into more sticky contractors, consultants. So we have to think about this in two ways. If we're utilizing contractors and consultants that are hired and paid through an agency or consulting firm, right, then those contractors and consultants actually become our fourth parties, and that firm is our third party. So it really depends on a lot of things, like how we're utilizing them, if we have some sort of management control over those individuals as they're performing work for us. But most likely the individuals that are actually performing the work are going to be covered under the HR policy. And if they are fourth parties, they should be listed as fourth parties to the hiring agency. However, contractors and consultants that are hired and paid directly through your organization should be covered by your HR policy. And I apologize, it says yes here, but that's incorrect. And they should be listed on your inventory. Any affiliate or subsidiary should be listed on the inventory and covered by your policy. Now, payees. This is a really interesting one. It is most likely not going to be governed by your third-party risk management policy. There's all kinds of reasons for that. A payee is basically a payment we're making. So that could be a payment to a board member, or it could be a litigation settlement payment. And we have to be really thoughtful about whether or not we're actually going to list these on the inventory. And we'll want to consult with compliance and legal about this. And the reason is there could be some pretty sensitive information. So unless we're going to lock down that entire inventory and completely minimize access to it, we may think about keeping payees as a separate list that we can always get access to. Now, one of the reasons for that may be, like, let's have an example of maybe there's an internal employee who had sued your organization for something and was given a financial settlement. That employee's name is going to show up on that list. And if everyone has access to it, that's not a good thing. So definitely consult legal and compliance just making sure that they can produce a list when asked by an examiner or an auditor. And then finally, sponsorships and donations, most likely they are governed by a separate policy, but they should still be on the list. So even though this is a third-party risk management policy, it's really going to require a lot of collaboration and communication and cooperation across the whole organization. And, you know, having gone through big changes like this myself, I know that there's often some roadblocks and challenges that pop up. So from an information, a process, and systems perspective, you might have a hard time putting together a single inventory because there's missing or incomplete information about those relationships, or there's conflicting or inconsistent information that's coming from different systems. If you have manual processes about this, it's really going to slow that information gathering and output. And you're probably going to discover there hasn't been a risk assessment or any management or oversight. You know, don't be surprised about that. That kind of takes us to the other side, which is more organizational and political. If you don't have a third-party risk management policy, which being a bank, I hope you do, and as well as other organizations, it's so fundamental, but now would be a really great time to get one. If there's a poor organizational understanding and adoption of third-party risk management, so people don't get it, they don't follow the rules, that's going to be a big hurdle. You are going to have stakeholders who are going to resist this requirement. They're going to say it's not a vendor, it's not a third party, and that's why you have to be prepared with that education and communication. One of the other issues is that you may have too many stakeholders, like everybody wants a vote and figure out how to solve these additional process issues, or not enough, right? So balancing that out is really important. The biggest one is that third-party risk management is not going to have enough resources to do such a large project. It's going to take some help from across the organization. If compliance is a low priority anyway, and adding this new expanded scope in, that is going to create some challenges, especially if the board and management are unfamiliar. So that's why we want to get it on that risk committee.
Our third poll question is, our existing inherent risk assessment process is manual, automated through third-party risk management software, we don't have one, or you're unsure. Hillary, we can go ahead and answer another question from the audience.
Great.
Should the master third-party inventory live in the third-party risk management system or in accounts payable?
That's a really good question. So as a first response, I'm going to say that because the interagency guidance that's requiring that inventory is on third-party risk management, it would be strongly advisable for you to carry that inventory within your system or your third-party risk management process. The other thing to keep in mind is that some of these external or relationships that aren't traditional vendors, they may not actually be set up in AP due to the type of relationship that they are. So I would, if at all possible, try and maintain the entire inventory within your third-party risk system. The other thing I want to keep in mind is just there may be parts of that inventory that have sensitive information. So you'll want to make sure that there's a good sort of access management on that inventory, like who can put eyes on it. So yes, put it in your third-party risk management system and processes whenever possible. I hope that helps.
And here are those results. Thanks, everyone, for answering this question. It's always interesting to see what everyone says. I'd like to mention that you'll find our 7 steps of risk-based vendor due diligence infographic and matrix available for download in the related content widget. These resources cover the process of risk-based due diligence for your vendor risk management program. Hillary, I'll pass it back to you.
All right, there's so much to think about here, and I know we've just scratched the surface, but I do want to talk about, not getting overwhelmed and moving forward. And really keeping one thing in mind is that the third-party risk management team or organization, or gosh forbid, even that individual, they're responsible for creating these frameworks to make it all work and make it all work for all these expanded new, business relationships. So what should we be thinking about? Well, first of all, it's important for your risk committee, your board, everyone to understand that this is going to take more time and effort to ensure that we get it right. And that may mean getting some extra resources. But we also want to make sure that our inherent risk assessments should be standardized regardless of the relationship type, okay? And we need to know that those due diligence requirements are appropriate to the risk and criticality of that third party, but those methods may be different. So we're going to need some folks to weigh in on what is acceptable. What kind of new questionnaires are we going to send out for different relationship types? What alternative documents are we going to look at? Are there any third-party relationships that don't require that formal review? Again, that might be the example of the contractor. They're not going to require that formal review because they're covered under that HR policy, and they do due diligence through background checks and references, et cetera. Do we have the right subject matter expertise in-house if we do have to review some of these risks from these other types of third parties? What kind of monitoring are we going to require? What's appropriate for that relationship? This is going to depend on the relationship to figure out what those standards are. How are we going to educate everyone? And what additional support do we need to make it happen? All right, I know we have covered so much, but we've also only scratched the surface. And I want to leave you with some important thoughts, if nothing else. The first one is read the guidance. And this link in the presentation will take you to the guidance, the Fed's version of the guidance, which for me personally was the best in terms of format and readability. They've also eliminated all of the public commentary and a lot of the things that made the original interagency guidance around 60 plus pages. So I would read that version. I would also take that version and do a self-audit on your program and really try and understand where you can meet these requirements today and where you can't, and then collaborate with your risk committee and compliance department so that they can help you get the visibility of the new guidance, that they can help maybe get you some resources, help with communications, think through some of these more complex relationship types. But start building your inventory, because that will help you create groupings of relationship types. And then once you have those groups, then you can start figuring out how to leverage your existing processes, but also adjust your existing tools. So once I know that I have, 10 different types of relationships, then I can think if I need 10 different, vendor risk assessment questionnaires. Always think about how other policies may be governing that due diligence or monitoring process. And like I said, raise your hand. This is going to be a big job, and your organization will be more successful when there's more stakeholders engaged in doing the work to get it done more quickly. Keep your management and your board updated of your progress. Let them know where the gaps were, what's happening to fix it, and Good luck. We will be talking about this more in the future, but for now, I'm going to turn it back over to Jessie for some Q&A. Jessie?
Thanks so much, Hillary. Before we dive into more questions and answers, I would like to thank everyone for attending. I would also like to thank Hillary for her time in sharing some important information. On your screen now, you will see our upcoming webinars. On August 8th, our ESG is Coming is your third-party risk management program ready webinar. And on August 17th, our How to Manage Vendor Risk at Your Credit Union with Due Diligence webinar. We hope you will be able to join us for those sessions. A link to register for those is in your copy of today's presentation slides. Let's now go ahead and answer some more questions that have come in during the session. Okay, Hillary, our next question is, in our current vendor management policy, we have a provision that executive or senior management can exempt a high-impact vendor from the due diligence process. Should we stop this practice due to the new guidance?
That is an interesting question. I would say yes. I think that it's really important to have consistency in execution of your processes. And what I think is really important here is to keep in mind that there is kind of a regulatory trend, not just with the OCC, FDIC, and all this, but with other regulatory agencies to start holding executives personally accountable for, large risk items and stuff. So I would say all relationships need to be properly risk assessed, and the due diligence needs to be appropriate and scaled to that risk, right? So if there's a high risk or critical relationship and an executive saying we don't need to do due diligence, that is potentially a big problem. It's kind of incorrect from a process standpoint, but it also could be a regulatory action item in the future. I hope that helped.
Great. Our next question. We are working on updating our program to comply with the guidance. There are some things that haven't been done in the past, for example, making sure that certain contract provisions are included. How would we document in our procedures that we will do these things going forward, but they weren't done in the past?
So I kind of a good way to phrase this is that this is, essentially our standard, and for existing relationships that do not comply, they will be brought into compliance, as soon as possible and practical. And I like to always include that as part of the policy because, especially where it comes to contracts, every organization's inherited contracts that weren't perfect as we go through, these updates and stuff. It is necessary, but you do need to acknowledge there may be some relationships that are not in compliance and that your organization is bringing them into compliance. However, if you say that, you need to prove that you are. So from the minute you identify someone who's out of compliance, you need to have a documented action plan as to how and when they will be brought into compliance.
Great. Next question. Do you think if lenders don't follow the guidelines, they will be penalized, monetary or not?
Yeah, I do think that the Fed and the OCC and the FDIC are pretty serious about enforcement actions. There's been a lot of chatter in sort of the legal environment that, these law firms that specialize in regulatory compliance, that enforcement is going to be probably more significant, considering that it's been almost 2 years since this proposed guidance has come out, and that they are being very specific about what they expect while still giving the organization flexibility. So yes, I do think there will be penalties for noncompliance.
Great. Next question. Do you see this guidance as anything actually new? It seems to me it just combined existing guidance into one document.
Actually, I don't see anything as particularly new. I see that the guidance was more closely aligned to the OCC's previous guidance, which was the most expansive and the most prescriptive. I also see what's new is more emphasis and explanation around, due diligence requirements, responsibilities of the board. But the one thing that is new is that all business relationships are in scope. So, I'm seeing some questions kind of pop up on the side here. We're wondering, is this in scope? Is this in scope? It's any business relationship excluding your customers, full stop. So that's the biggest change.
Wonderful. Next question. Are you suggesting we put in donations in short-term relationships?
Yes, absolutely. Any third-party relationship, whether it's a one-time use or a donation, should be listed on that inventory. Granted, there's some organizations that have a lot of that. What we want to see is that the relationship was risk assessed and managed appropriately. So it's the guy who brings tablecloths and balloons to your banking branch opening. Yes, that needs to be listed. It should be risk assessed. And if it's a low risk and there's not a lot of extra that needs to be done, that's fine. You just need to demonstrate that you considered it and evaluated it from the beginning.
Perfect. Next question. What about pay-as-you-go vendors? Vendors we use regularly but have no contract or agreement with them.
Yep, they're included. Every business relationship.
Great. Next question. Does every type of third party have to follow the life cycle?
In theory, yes. What's important about the life cycle, and whether it's, the version that we show you with all the different steps or the regulator's little triangle, container, there's basically 3 stages to that life cycle. There's onboarding, which means we plan for the relationship, we risk assess it, we do appropriate due diligence, and we think about how we're going to manage that relationship and prepare that contract or that agreement, right? That applies to whether it's a revenue sharing agreement or, your data provider or your core systems provider. Yes, so it does apply. And then the second part that's really important is how we monitor that relationship. So, for example, performance monitoring for that revenue sharing relationship might look a lot different than for your call center, but you still need to do some. And you also need to periodically review the risk. Now, how often you do that may really vary depending on that relationship, but you still need to demonstrate that it's being done. So essentially, yes, it does apply, but remember, everything is risk-based depending on the type of relationship and the risk it brings to your organization or your customers, and that's where the little bit of flexibility comes in. But whatever you decide to do, you need to make sure that you can defend those decisions to an examiner or an auditor if they should ask, why are you only looking at this relationship every 3 years, for example.
Great. I think we have time for one more question. I'm concerned that recommending the use of our risk assessment questionnaire may lead to various internal political issues. What could you suggest to avoid that?
It may, right? Because people are going to sometimes be very resistant to doing things in a way that they're not used to. What I would suggest, again, is bringing this up to the risk committee and leveraging those existing tools. Now, that's not to say you might need to look at your inherent risk assessment and add a question or maybe some additional categories so that it's appropriately applicable, okay? But keep in mind when you're talking to your risk committee, that group of benefits I showed you about the consistency, kind of using the same yardstick, and that inherent risk assessment automatically is going to pull it into your third-party risk management process so that you can report on it. Those should be enough benefits to kind of help push back or ease some of those challenges. But I guarantee you there will be some people who are like, I don't want to do that. It's just part of what we do in third-party risk management. We have to make it work.
Wonderful. Unfortunately, that is all the time we have left for questions today. Thank you, Hillary, for taking the time to address some of those that came in. Any questions we did not have time to answer today, we will address with you offline. We would like to thank you all for attending and hope you found today's session valuable. A big thank you to Hillary for her time and content. You can ask even more questions inside of our third-party think tank, an online community that is dedicated to third-party risk professionals and free to join. Just because today's session has ended doesn't mean the conversations and questions must. Post your questions at thirdpartythinktank.com and see what your peers have to say. In the community, you'll find thousands of free educational resources related to third-party risk management topics, such as regulatory guidance to assist you. If you'd like to become a member of Third Party Think Tank, you can register on the site or shoot us an email, and we'll get you registered and send you a link to set your password. We did record today's session, and that recording link will be provided to you in a follow-up email that you will receive tomorrow afternoon. Also in that follow-up email will be the survey link for you to request a CPE credit. On behalf of VidMinder, it has been a pleasure. Thank you, and have a great rest of your day.